The S&P 500 just broke a level that almost always signals trouble, and the last time this exact pattern appeared, the market collapsed and trillions were wiped out. The scary part? Most investors think this is just a normal dip, but the data says something very different.
The S&P just cracked a level it defended 6 times in a row. And the last time something like this happened, the market dropped 34% in under 2 months. Is your portfolio ready for what comes next? Drop your answer in the comments right now. Do you think this dip gets bought, or is this the start of something much bigger? Let's cut through all the noise, because right now the financial media is doing what it always does, pointing at the shiny object. Iran, oil at $90, geopolitical tension. And yeah, those things matter, but if that's all you're watching, you are going to get absolutely blindsided by what's building underneath the surface of this market. Today, we are going deep. We're talking the S&P 500 breakdown, the unemployment numbers that nobody's connecting the dots on, a major American financial institution that just lost nearly a quarter of its value, and a chart pattern that is quietly screaming that the real pain hasn't even started yet. Stay with me, because what I'm about to show you changes how you look at every single market headline for the rest of this year. Let's start with the S&P 500, because Friday's move was not just a bad day. The index fell 1.33%. Fine, that happens. But here's what makes this different. There's a price level at 5,790 on the S&P 500 that acted like a wall. 6 separate times over the past several months, the market tested that level. 6 times it held. Bulls pointed to it. Institutions defended it. Retail investors used it as their safety blanket. Friday, it broke. And when a level that important breaks, especially on volume, especially with the macro backdrop we're sitting in right now, you don't just shrug it off. That's not a blip, that's a signal. Now here's what the TV anchors aren't telling you. This breakdown started before oil spiked. The cracks in this market were forming before a single Iranian drone was launched. The geopolitical news didn't create the vulnerability, it just exposed it, which means when oil cools down, and it will, don't mistake the relief rally for a recovery. That's the trap. Hold on, because before we go further, I need to show you something in the jobs data that should genuinely concern every American with a retirement account. The most recent Non-Farm Payrolls report came in at minus 92,000 jobs. Let that land for a second. The U.S. economy shed 92,000 jobs, and that report was compiled before the Iranian conflict escalated, before oil crossed $90, before the latest inflation prints came in hot. Unemployment is now sitting at 4.4%. That doesn't sound catastrophic on its own, but here's the trajectory that should keep you up at night. Companies like Block just announced they're cutting 50% of their workforce, citing AI. Oracle is preparing thousands of additional layoffs. Same reason. AI isn't just disrupting tech, it's eating jobs across every sector, and the ripple effects are only beginning. The projection here is that unemployment crosses 5% by early 2027. That is not a fringe forecast. The labor market data is already pointing that direction. But here's where it gets truly dangerous. You don't just have weakening jobs, you have weakening jobs combined with rising inflation. PPI came in hot, PCE came in hot, and we haven't even seen a CPI or PPI print that captures what $90 oil does to the supply chain. That combination, slowing growth, rising prices, has a name: stagflation. And stagflation is the scenario that even the most seasoned investors fear most, because the Federal Reserve has almost no good options. Raise rates to fight inflation, and you crush an already weakening economy. Cut rates to stimulate growth, and inflation spirals further. It's a genuine policy trap. If this kind of breakdown is new to you and you want to stay ahead of moves like this in real time, make sure you're subscribed and hit that bell, because this analysis goes up the moment the market gives us a signal. Now let me show you something that most people completely ignored on Friday, and it's one of the most important signals in the entire market right now. American Express, one of the most recognized financial brands in America. A company that sits at the intersection of consumer spending and credit health. From its highs in late December at $387 per share, American Express bottomed out on Friday at $295. That is a 24% decline in roughly 3 months. Because American Express isn't just a credit card company, it's a real-time gauge of how the American consumer is actually doing. When high-income cardholders start pulling back, when charge-off rates tick up, when a company of that size and prestige drops nearly a quarter of its value, the market is telling you something about the health of the underlying economy that the GDP headline numbers won't catch for another 2 quarters. And on Friday, a major U.S. bank disclosed a $126 million write-down on a single bad loan. Private credit markets, the shadow lending system that ballooned during the zero interest rate era, are starting to crack. These aren't isolated incidents, they're the early tremors before the earthquake. So what does the chart actually tell us about where the S&P goes from here? Because there's a specific pattern forming right now that has a serious historical track record, and the price target it's pointing to might genuinely shock you. Technical analysis gets mocked sometimes, especially by people who've never used it to call a top or a bottom accurately. But the market leaves fingerprints, and right now, those fingerprints are forming one of the most recognizable bearish structures in all of charting. It's called an inverse cup and handle. Here's how to visualize it. Imagine the classic cup and handle pattern that bulls love: a U-shaped base, a brief pullback handle, then a breakout to new highs. Now, flip it upside down. You get a rounded top, a brief bounce, that's the handle, and then a significant leg lower. That is exactly what the S&P 500 is currently tracing out on the longer-term chart. The rounded top is already formed. The current market action, including the oil-driven sell-off, is the beginning of that handle formation. When oil eventually cools and the market gets a relief rally, most investors will call the bottom and pile back in. That rally is the handle completing, and then comes the bigger drop. The technical price target on this structure points down toward the 5,600 level on the S&P. That's not a doomsday prediction. It accounts for the bounces along the way. But getting from current levels to 5,600 represents meaningful additional downside from here. The Dow tells the same story. When the Dow hit 50,000, the long-term resistance trendline predicted the rejection almost to the tick. Now it's showing support near 45,700, but if that gives way, the next leg down accelerates.
Smash the like button right now if this kind of chart-backed, data-driven analysis is what you want more of. It genuinely helps this channel reach more people who need to hear this before it's too late. Here's the playbook that makes sense in this environment. The near-term move is likely a bounce, particularly in tech. On Friday, the NASDAQ Composite actually held its key support level. Microsoft and Google closed relatively flat. The tech sector showed relative strength, which suggests a short-term relief rally is probable before the next leg down. For traders, that means the financial sector, which got beaten up hard, could offer a short-term opportunity on any gap-down Monday open, particularly names that hit major technical support. But this is a trade, not an investment thesis. The bigger trend is down. For long-term investors, this is a moment for discipline over emotion. The pattern says we haven't seen the real bottom yet. Cash is a position. Hedges make sense, and watching the next CPI print with oil factored in will be enormously important, because if inflation reaccelerates while growth slows, the Federal Reserve's already limited toolkit gets even smaller. The Bitcoin parallel is worth noting too. Bitcoin peaked at $127,000, ground sideways for weeks while bulls called it healthy consolidation, and then broke down hard. The S&P appears to be running a similar pattern, just on a delayed timeline. Here's the bottom line. The Iranian conflict is real. Oil at $90 is real, and they absolutely add pressure to this market. But the foundation was already cracking. The jobs data, the inflation trajectory, the credit stress showing up in major financial institutions, these were all in motion before the geopolitical headline dropped. The market is in the early stages of forming a pattern that historically leads to a significant multi-month decline. There will be bounces, there will be relief rallies that feel like recoveries. Don't mistake them for the all clear. Stay sharp, stay informed, and position yourself before the crowd figures out what the charts already know. Now, I want to hear from you. Are you buying this dip, holding cash, or already hedged? Tell me in the comments. And if you found this breakdown valuable, share it with one person who has money in the market right now. They need to see this. I'll see you in the next one.